Hello and welcome to my channel Happy Hours. In my last video I discussed about the tax avoidance and taxes in news, where I discussed about the helicopter drop economy, income disclosure scheme 2, issues with the avoidance of tax, some steps to control the tax avoidance and about the taxes in news. In this video, I'm going to discuss about the money and banking, about the definition and function of money, legal tender, difference between the money and the currency, concepts like demand for money, inflation control, unrealized capital gain, supply of money, equilibrium rate of interest, and the increase in demand for money and its impact on the rate of interest. So, what are we waiting for? Let's jump to the topic money. What is money? Money is anything which people generally accept for various transactions. Thus, general acceptance is an important feature of money. If people are ready for transactions, then it will also be considered as money. Checks and drafts are also example of money. Currency and money are different. Every currency is money, but every money is not currency. Coins can be accepted up to certain prescribed limits only we can and we cannot force someone to accept after that limit. That is a concept called money and near money. Near money is proximate to the money, like the checks, demand draft, etc. General acceptance is a big criteria to accept it as a money. Next, I'm going to discuss about the functions of money. There are three functions. First is the medium of exchange, second, store of value, and the third is unit of account. Now, we all know that money is the medium of exchange. And suppose there was 500 note and 1000 note, they were having the low soil rate. That's why it was considered as a store of value. Or we can say that it was assumed that the people can store them as the black money. It was at the time of demonetization. This was the conception behind it. That's why the money is going to be stored because it is of higher denomination, then the people are going to store it easily. People store their money in the form of property also, like houses or a big building. So during demonetization, these money cannot be demonetized. Means if they have stored in the form of a building, you cannot demonetize it. Only the currency which is demonetized can be reduced from the market. To quantify the money, we need an unit of account. If account is not there, then how government can do the audit? A unit of account is standard numerical monetary unit of measurement of market value of goods, services and other transactions. And this is also known as a measure or standard of relative worth and deferred payment. A unit of account is necessary prerequisite for the formulation of commercial agreements that involve debt. So the unit of account is for the audit also and for the debt involvement also. And the unit can be like rupees, dollar or any other. Next topic is here is the legal tender. Legal tender is legal money or currency which is used for doing various transactions including repayment of debt. If someone has given loan to somebody and that person want to return the debt, so that person have to accept it. At that time he cannot say that yes I cannot going to accept it. It can be in any form. So a legal tender can be divided into two parts. First is limited and another is unlimited. Limited, which can be accepted only up to an extent, like the coins, including the banknote of rupee 1, because it is considered coin under the Indian Coin Act 2011. Whereas if we are going to understand the unlimited legal tender, it is which must be accepted without any limit, means the bank notes. Now we have to understand what is the difference between the money and the currency. Till now, we were understanding the concept of money. Anything which is used for the transaction is known as money, whereas every money is not the currency. Currency is can be money. Currency is the money, but the money cannot be currency always. So now let's understand by this, like we have when we are deposit or we are doing some kind of fixed deposit, so it is time bound, and even the money is also fixed. This is also a kind of money, but it is not currency. And if we have to take out it in the form of currency, then we have to wait for the expiration date, means expiration time, and by that only we can take out that money. We can do, if suppose we have to take it back between the time period, then there is a procedure which is going to be followed by the bank. There is another kind of money, that is the check or the demand draft. These all are also money, but these are not currency. Next, we are having the demand for money. What is demand for money? Is like any commodity, people also demand money for conducting various transactions. The demand for money depends on following two items. First is the rate of interest, and the second is the level of income. The demand for money is inversely associated with the rate of interest. In other words, if the rate of interest is higher, then the demand for money will be less. Similarly, if the rate of interest is lower, then the demand for money will be higher. The demand for money is positively associated with the level of income, in the sense that if the level of income is higher, then the demand for money will also be higher. And if the level of income is lower, the demand for money is also going to be lower. Whenever we are having income which is higher, then consumption is also going to get increased. Then money is also kept in the form of cash. Means whenever there is the income is higher, then you will need to consume more. And when you are consuming more, it means it is in the form of liquidity, means in the form of cash. So the money can be transacted easily, whether it is digital format or as hard cash. So the demand for money is higher when the income is higher, and it is lower when the rate is higher. Whenever the rate of interest increases, people will demand less money, because it is the opportunity for them that they are going to earn more and more interest on their savings. So the consumption is going to get reduced, and people will compromise, because they know that if they are going to compromise some of their consumption, they will be easily going to get more and more interest on the money. For the long run, they are thinking of their benefit, and by that they are reducing their consumption. By this, the government is controlling the inflation also. Because inflation is what? It is about the price of commodity, goods and services. If the rate of interest is increased, then the demand for commodity decrease. And as the demand of commodity decrease, the demand for money is going to decrease. And by this, the inflation is controlled. Any demand for money is purposeful, we all know. Whenever we are demanding, it means we need to consume it somewhere. So to reduce, to control the inflation, we use the tool which is known as the rate of interest. So suppose the rate of interest is going to be increased by the central bank, then people are going to somehow compromise their consumption, and by this the inflation is going to get in control, because the money in the market is going to get reduced. At a particular given level of income, the demand for money at various rates of interest can be shown in the figure. We can understand through the figure, where we can have a graph, like in one side, vertical side, we will have the rate of interest, and horizontal side, we will have the demand for money. And the graph will be a negative slope, and we will understand that it is going downward. Means whenever the rate of interest is going to increase, the money supply, money demand for money is going to get reduced. Now there is a concept which is related to this, like the unrealized capital gain. An unrealized capital gain is an increase in the value of an asset or investment that an investor has not sold, such as an open stock position. For example, we can understand if we bought a stock of any product at the rate of rupees 30, suppose, per share, and most recent it is quoted that the price is now the 42 rupees. Now we are sitting on an unrealized gain that is of rupees 12. The unrealized gains and losses are also called paper profits or losses because the gain or loss only exists while the asset is in the investor's possession or on paper, generally on the investor's ledger. This is what happening in USA. They're the billionaire, they are not paying their income tax in the legal way. Because what they are doing, they are taking the loan, and since you are not supposed to pay any tax on the loan, and by that loan they are buying the equity, and this equity by time to time it is gaining some profit, and since they are not selling them, so the price of equity is increasing and they are getting the unrealized capital gain, and they are not paying the tax to the government. So we can understand this is a problem with the unrealized gain, which is giving the problem to the countries. Now we are having the next topic, which is known as the supply of money. The supply of money is determined by the central bank and is independent of the rate of interest. This can be understood by this graph where we are having on the x axis the interest rate and the y axis we are having the quantity of money per period, and we get a vertical curve. Through the money supply control, central bank control the rate of interest, and if the money supply will increase, the rate of interest will fall. When the price of commodity is higher, then the supply is made lighter, higher, so that the price will get reduced. And only the central bank can determine the supply of money because they are looking for the market. The regulatory bodies are not profit oriented, but what they can do, they are gaining the profit. Now, if we have understood, we can see the figure. It can be mean for that the money supply remains independent of the rate of interest. We are having a question here. When the somebody is withdrawing money or he is keeping the money in the bank, suppose, is the rate of interest or supply of money get affected? We can understand that no, the the withdrawing or keeping the money in the bank by a particular person is not going to affect the money supply or rate of the interest. Now we are having the another topic which is known as the money velocity. The velocity of money measures the number of times that one unit of currency is used to purchase goods and services within a given time period. In other words, it's how many times money is changing the hands. Now next topic is here is the equilibrium rate of interest. The equilibrium rate of interest is the rate of interest at which the supply of money equals to the demand for the money, and it is in the economy. It is represented it represents a balance or equilibrium in the money market and is determined by the central bank. We can understand this by the figure as shown below. Here we can see that the demand and supply matches as the rate of interest is equilibrium. A rate of interest where demand and supply for money is equal is known as the equilibrium rate of interest. When the demand of money is less than the supply of money, there is a gap in between supply and the demand. Now next we are having a question which is the increase in the demand for money and the impact of the rate of and the impact on the rate of interest. So we can understand this also by a diagram. If the money supply remains constant, suppose, then the demand for money increases. Then the rate of interest will increase. When demand is higher and supply is limited, then the prices are made higher so that the consumption gets reduced. When there is a demand for money is higher and the supply of money is constant, then the rate of interest is made higher so that the people are going to keep their money in the bank in the form of deposit. Then finally the demand for money will automatically get reduced. By this, I am concluding my video, and if you find my video useful, then please like and subscribe. Thank you.